Imagine waking up on a Friday morning, January 31st, 2026, and checking your phone. Gold, the metal that has been humanity's ultimate safe haven for 5,000 years, is in free fall. Not down 1%, not down 5%, down 12% in a single day, the biggest crash in 40 years. And silver? Silver has lost 31% of its value before lunchtime, in a single trading session, gone, vanished, evaporated into thin air. This isn't a movie. This isn't a simulation. This is the real story of the most jaw-dropping precious metals collapse in modern history, and what it means for every single person on this planet. But here's what makes this story even more insane. Just 4 days earlier, gold was sitting at an all-time record high of $5,595 per ounce. Silver had just hit a breathtaking $122, a level nobody in the history of financial markets had ever seen before. Investors were euphoric. The headlines were screaming about generational wealth opportunities. Financial analysts were revising their already bullish forecasts even higher. And then, in 28 minutes, it all began to collapse. So, how did we get here? How did the world's most trusted stores of value go from record-breaking highs to historic crashes in the span of 72 hours? And most importantly, is this the end of gold and silver's legendary bull run, or just a terrifying pause before the next launch? Buckle up, because what you're about to hear is a financial thriller that reads like fiction. But every single number, every single fact, every single twist is completely real. To understand the crash, you have to understand the rocket ship that was built before it. Let's rewind. In the 12 months leading up to January 28, 2026, gold's spot price rose a staggering 96%. Think about that for a second. 96% in 1 year. The asset that is supposed to be boring, slow, and steady doubled in value in 12 months. But gold's gains were modest compared to silver. Silver's spot price surged 278% in the same 12-month period, rising from $30.82 per ounce all the way to $116.61. That is not a rally. That is a nuclear explosion. And here's the truly staggering part. In January 2026 alone, just 1 month, gold gained 29.5%. And silver? Silver gained 68.5% in a single month. According to precious metals experts, that was silver's strongest monthly gain since December 1979. Think about what that means. Nothing in the modern financial world had performed like this. Not Bitcoin, not tech stocks, not any commodity on Earth. Gold and silver had gone completely parabolic. The World Gold Council would later describe the run as gold setting more than 50 all-time highs in 2025 alone, making it the 4th strongest annual gold performance since 1971. This wasn't just a bull market, it was something nobody had a name for yet. But nothing goes up forever without a reason. And gold and silver had the most powerful collection of reasons driving them that anyone had ever seen in a single moment in history. Let's break them down one by one, because each of these factors is a story in itself. The first force was central bank buying, and this was no ordinary shopping spree. According to World Gold Council data, central banks purchased 248.6 tons of gold in just the first quarter of 2025 alone, the highest quarterly purchase ever recorded in history. And this trend didn't slow down, it accelerated heading into 2026. But why were central banks around the world suddenly hoarding gold like there was no tomorrow? The answer is one word: de-dollarization. China had been steadily reducing its U.S. Treasury holdings from $1.3 trillion in 2011 all the way down to $765 billion. At the same time, China was aggressively stockpiling gold. Poland, Kazakhstan, India, Turkey, all buying. The National Bank of Poland alone added 83 tons through October 2025, pursuing a target of raising gold to 30% of its total reserves. This wasn't speculation. This was sovereign nations quietly, deliberately, methodically moving away from the US dollar as their primary reserve asset and moving toward gold. The second force was geopolitics. and 2025 was one of the most chaotic geopolitical years in recent memory. When a U.S. naval blockade was ordered against sanctioned oil tankers in Venezuelan waters in December 2025, gold spiked immediately. When U.S. tariffs triggered a full-blown trade war with China, investors fled to safe havens. When Middle East tensions reached boiling point, when maritime frictions erupted between China and Japan, when Ukraine's war dragged on, every single flashpoint sent capital pouring into precious metals. The European Central Bank's own research confirmed that official sector gold demand is heavily shaped by geopolitical risk. Investors weren't just buying gold for profit anymore. They were buying it for survival, as insurance against a world that felt increasingly unstable, unpredictable, and dangerous. The third force was the Federal Reserve. Throughout 2025, the Fed had been cutting interest rates, bringing the federal funds rate from its restrictive peak down to 3.5 to 3.75% by December. And here's the economics lesson that changes everything. When interest rates fall, gold thrives. Why? Because gold pays no interest. When rates are high, you can earn solid returns from bonds or savings accounts. Gold looks boring by comparison. But when rates fall, those returns evaporate, and suddenly gold's stability and scarcity look incredibly attractive. Every rate cut was essentially rocket fuel for gold and silver, and investors worldwide knew it. The fourth force was silver's secret weapon, one that most people never talk about. Silver isn't just a precious metal. It's a critical industrial input. It's in your solar panels. It's in your electric vehicles. It's in AI data centers and semiconductor chips. Silver demand from the green energy transition and the artificial intelligence boom had been compounding on top of the safe haven demand. Supply deficits had been building for years. Unlike gold, which has significant above-ground stockpiles, silver was genuinely running short. The market was structurally in deficit, and when industrial demand collides with safe haven demand collides with speculative momentum, you get a parabolic move that breaks every forecast. Goldman Sachs had predicted gold would reach $4,900 per ounce by December 2026. That target was obliterated months ahead of schedule. Morgan Stanley's forecast of $4,800 was left in the dust. Citigroup's target of $5,000 for the first quarter was hit and smashed. The world's biggest banks couldn't keep up with what gold and silver were doing. By late January 2026, analysts were scrambling to revise their numbers upward in real time. And then came January 29th, 2026, a Wednesday, the day the cracks began to appear. At 10 o'clock in the morning New York time, something unusual happened in the trading data. Gold prices dropped $380, nearly 7%, in just 28 minutes. Silver collapsed 11% in the same window. This wasn't the crash yet. This was the warning shot. The market wobbled, then steadied. Gold clawed back some ground. Silver bounced. Nervous traders told themselves it was just profit-taking, just normal volatility in a hot market. They were wrong, because on Thursday, January 30th, the bombshell dropped. President Donald Trump formally nominated Kevin Warsh to be the next chairman of the Federal Reserve. And those three words, Kevin Warsh, Fed Chair, hit precious metals markets like a freight train. Why? Because Kevin Warsh is known as a hawk, a monetary policy hawk, someone who believes in fighting inflation aggressively, which means higher interest rates, or at least resistance to cutting them. The very opposite of what gold investors had been counting on. In seconds, the entire narrative that had powered gold and silver to record heights began to unravel. If the Fed wasn't going to keep cutting rates, if the days of easy money were numbered, then one of the most critical pillars under gold's rally had just been kicked away. The US dollar surged. And when the dollar surges, gold falls. It's one of the most reliable relationships in all of financial markets. As the dollar strengthened, commodity currencies, including the Australian dollar and Swedish krona, sold off sharply. And precious metals, priced in dollars, became more expensive for foreign buyers around the world, instantly reducing global demand. But it wasn't just the Warsh nomination. The crash of January 31st was a perfect storm of multiple forces colliding simultaneously, a once-in-a-generation convergence that turned a correction into a catastrophe. January 31st also happened to be the last trading day of the month. Month-end in futures markets is always volatile. Traders are rolling positions, closing contracts, managing portfolios. But February 1st fell on a Saturday, meaning the futures markets wouldn't reopen until Sunday evening. Traders holding positions had no ability to adjust them over the weekend. Every adjustment, every hedging decision, every panic sale had to happen on Friday. The window was compressed to a single day, and when you add margin calls on top of that, when traders who had borrowed money to amplify their gold and silver positions suddenly faced demands to put up more collateral or be forcibly liquidated, the selling pressure became unstoppable. Gold's RSI, the Relative Strength Index, a measure of how overbought an asset is, had recently touched 90. Silver's RSI had reached 93.86. According to OCBC strategist Christopher Wong, those readings were the highest for silver since 1980. As Saxo Bank commodities analyst Ole Hansen put it, and this is the quote that perfectly captures what happened, quote, "The problem is volatility feeding on itself. As price swings intensify, liquidity thins. Banks and market makers struggle to manage risk. When their willingness to quote prices in size fades, liquidity deteriorates, and volatility blows out." When the closing bell rang on January 31st, 2026, the damage was historic. Gold futures for April delivery closed at $4,745 per ounce, down 11.4% or approximately $600 in a single day. At its intraday low, gold had touched $4,700. From its peak of $5,595 just days earlier, gold had lost nearly $900 per ounce. Silver's carnage was even more brutal. From its peak above $122, silver had plunged to below $85 at its worst intraday level, a collapse of more than 36% at the depth of the sell-off. According to Nitesh Shah, head of commodities at Wisdom Tree, January 30th will likely go down as one of the most volatile days ever for both gold and silver. And his summary is as blunt as it gets. Quote, "These are price swings you would normally expect over the course of a year, not within a single trading session." The total destruction of value was staggering. Gold's market cap alone shed approximately $3.4 trillion in value. Mining stocks collapsed. Gold and silver ETFs recorded massive losses. Billions of dollars of paper wealth disappeared in hours. Ordinary investors who had bought gold and silver near the highs, many of them everyday people seeking protection from inflation and economic uncertainty, watched their portfolios bleed. But here's where the story gets even more complex and more honest. Because the crash, while terrifying, did not erase everything. And what survived the crash tells us something very important about where we go from here. Despite losing 12% on its worst day in 40 years, gold was still up 18% for the year as of January 30th. Let that sink in. Even after the most catastrophic single-day drop since the early 1980s, gold was still one of the best-performing assets of early 2026. Silver, despite its 31% single-day collapse, was still up 40% for the year. These aren't numbers that suggest the bull market is dead. These are numbers that suggest an asset that ran too far, too fast, had a violent but perhaps necessary correction, while still sitting dramatically above where it started. Standard Chartered's Suki Cooper, who leads the bank's global commodities research team, said she wasn't surprised by the sell-off at all. She had been warning that both metals were trading in, her exact words, aggressively overbought territory. And crucially, she said the correction was needed. Quote, "Both markets were due a correction, particularly to maintain the long-term uptrend. The important word there is long-term, not dead, not over, just correcting." Naeem Aslam, CIO at Zay Capital Markets, offered perhaps the most insightful diagnosis of what went wrong. Quote, "Inflation data did not suddenly shift. Policy expectations did not reverse overnight. What failed was the assumption that assets widely seen as defensive would remain liquid under stress." Translation: gold and silver didn't fail as stores of value. They failed as liquid trading instruments when everyone tried to exit the same crowded trade at the same time. There's a profound difference, and the major banks wasted no time reasserting their long-term bullish stance. UBS, one of the world's most respected financial institutions, significantly raised its 2026 gold price targets after the crash, lifting forecasts for March, June, and September all the way to $6,200 per ounce. That's a 24% increase from their previous target of $5,000. And in their most optimistic scenario, if geopolitical tensions escalate sharply, UBS said gold could reach $7,200 per ounce. JP Morgan maintained its forecast that gold demand would push prices toward $5,000 per ounce by year-end 2026, with an average of $5,055 in the final quarter. JP Morgan's Natasha Kanova, head of global commodities strategy, put it plainly, quote, "While this rally in gold has not, and will not, be linear, we believe the trends driving this rebasing higher in gold prices are not exhausted." WisdomTree's Nitesh Shah went further, describing something truly significant that the mainstream financial media is largely ignoring. He called it a structural regime shift. The buyer base for gold is broadening in ways that are genuinely new. Chinese insurers, Indian pension funds, digital and tokenized gold products. These forces, he said, are pushing prices into territory that traditional valuation models struggle to capture. This isn't the gold market of 1980. This isn't even the gold market of 2008. This is a fundamentally different animal, with new buyers, new demand drivers, and new structural reasons to own precious metals that didn't exist a decade ago. Silver's industrial story is, if anything, even more compelling as we look ahead. Solar panel production requires silver in quantities that are growing exponentially as the world accelerates its green energy transition. AI data centers and the semiconductor supply chain are consuming silver at rates that analysts are only beginning to model accurately. The physical silver deficit, where demand exceeds new mine production, has been compounding for years, and supply can't simply be turned on like a tap. New mines take a decade to develop. Recycling fills some gaps, but not all. The structural undersupply of silver is not a short-term problem. It is a medium and long-term reality that any serious analysis of the silver market must confront. So where does this leave us? After the euphoria, after the crash, after the dust begins to settle, what is the real story of gold and silver in 2026? The honest answer is that we are witnessing something genuinely historic. Not because of the crash. Crashes happen in every market. But because of what drove both the rally and the crash reveals about the state of our world. Central banks are quietly but urgently diversifying away from the dollar. That is not speculation, that is documented fact. Geopolitical fragmentation is accelerating. That is not paranoia. That is the consensus view of every major international institution from the IMF to the World Bank. The AI and green energy revolutions are creating structural industrial demand for silver that is only beginning to be understood. And the Federal Reserve, regardless of who chairs it, is operating in an environment of unprecedented global debt and fiscal pressure that makes the simple old playbook of raising rates obsolete. Mark Matthews, head of research for Asia at Bank Julius Baer, told Al Jazeera, and this is perhaps the most honest summary of the entire episode, quote, "The more likely explanation is that precious metals prices collapsed simply because they had already gone parabolic in the previous week. Once profit-taking started, it just snowballed. Not a fundamental collapse, not a change in the underlying story, just gravity catching up with something that had defied it for too long." The gold and silver crash of January 2026 was not the end of a story. It was an explosion in the middle of one. The forces that built gold from under $3,000 to over $5,500 in a single year have not disappeared. They have not been addressed. They have not been resolved. The geopolitical tensions that drove safe haven demand are still simmering. The de-dollarization trend that has central banks stockpiling gold is still accelerating. The silver deficits that industrial demand has created are still compounding. The global debt burden that makes paper currencies less trustworthy by the day is still growing. What changed on January 31st, 2026 was not the story. What changed was the price. And for those watching closely, that difference matters enormously. History has a pattern that is worth remembering right now. After gold's previous surge from $3,000 to $5,500, it experienced almost no significant correction along the way, until it did, violently, suddenly, and briefly, and then it continued higher. The April 2013 crash saw gold fall 25% over several months before finding its bottom. Those who sold at the bottom locked in their losses permanently. Those who understood the underlying forces and held their positions, or better yet, added to them at lower prices, were eventually rewarded. The question every investor, every nation, every institution is now wrestling with is simple, and it is ancient, and it is as relevant today as it has ever been in the history of human civilization. When the world is uncertain, when governments are borrowing beyond their means, when currencies are being debased, when wars are being fought and trade routes are being contested and trust between nations is fracturing, where do you put your wealth to keep it safe? For 5,000 years, humanity's answer to that question has been the same. And on January 31st, 2026, after one of the most dramatic crashes in modern financial history, that answer remains unchanged. The crash was real. The pain was real. The losses were real. But so are the forces that made gold and silver reach those heights in the first place. And those forces, every single one of them, are still very much alive.